Audit risk is the risk that the auditor issues an unqualified opinion when the financial statements are in fact materially misstated. Audit risk is a function of the inherent risk, control risk, and detection risk. Inherent risk is a likelihood of arriving at the wrong conclusion based on the client's business. Control risk is the risk that the client's internal controls won't detect or prevent mistakes. Detection risk is the risk that the auditor won't detect material errors. When inherent risk and control risk are high, then detection risk is low and vice versa. Audit risk can never be zero, but can be reduced to an acceptable level by a thorough risk assessment and planning the audit appropriately. Audit risk minimization strategy involves identification of accounts most at risk of misstatement, an evaluation of the client's internal controls, and detailed testing of each identified account based on the level of risk.
Given that Cascade has international operations and subsidiaries, the company records complex transactions that lead to a risk of misstatement on various accounts. These accounts include gain losses on foreign exchange and the consolidation of the various financial statements. Moreover, the company adapted the newest changes to IFRS. Changing accounting policies can increase risk of misstatement as management and accounting departments become familiar with the new rules. The most significant income statement accounts at risk of error are sales and cost of sales. In a competitive industry, the bias tends toward overstating revenues and understating expenses. Those two components of the income statement are inherently at risk, since KPIs and management compensations are based on profitability. And the factors, the inherent risk that can directly affect the balance sheet or certain amounts of these risks that I have listed, but here I will talk about the two most important of those risks. First one, accounts receivable. The rate of risk is high. The factors that to be considered are these are the factors to be considered should be valued at net realizable amount, have proper aging and collection procedures been followed, is the associated bad debt expense reasonable. Cascade sells its European account receivable through a factoring contract with a financial institution. When the receivables are sold, the company removes them from the balance sheet, recognize the amount of receivable as the consideration for the transfer, and records a loss on factoring, which is included in the financing expenses. The complexity of these transactions increase the inherent risk of misstatement of both affected accounts. The second one is investment in associates. Acquisition of other businesses may expose the corporation to additional risk, including difficulty in integrating and managing newly acquired operations, and in improving their operating efficiency, difficulty in maintaining uniform standards, controls, procedures, and policies across all of the corporation's business. Entry into market in which Cascade has little or no direct prior experience. The corporation's ability to retain key employees of the acquired corporation, disruption to the corporation ongoing business, and diversion of management time and resources.
In this section, I will use analytical procedures to identify sections of the financial statements which are more at risk of misstatements. Analytical procedures will also enable our audit team to address the nature, timing, and extent of audit procedures to be performed during our audit. These preliminary reviews will compare financial statement items between 2015 and 2016. We will also use common size analysis to identify plausible relationships between financial and non-financial items. Given the limitations placed by the size of this video, I will focus on the most significant variations, but you can find a more detailed analysis in the report that we have provided to support this presentation. Starting with sales, Cascade sales have increased 3.63% versus 2015. Cost of sales increased about the same percentage, that is 3.65 versus 2015. The company operates in an industry with seasonal and volatile direct material prices, so we would expect a different variation. Well, maybe the company may have hedged against cost increases for its direct materials, which is mainly virgin fiber. Otherwise, we would not expect the same percentage increase in cost as in revenue. We have to pay more attention to cost of sales during our final audit. Gross profit margins stayed the same as last year, that is at 15%. Cost of sales still represents about 84% of total sales. Operating income increased 44.4% versus 2015, and this has been mainly due to a significant drop in the restructuring cost and also in impairments for the period. We will focus more attention on whether restructuring is complete and also look at the impairments that have been processed for this period to see if they are adequate. Another area at risk is property, plant, and equipment. Most companies in this industry expect to invest significantly in property, plant, and equipment. And they do this principally through debt financing. Long-term debt in the financial statements represents 40% of the total assets. We notice that the financing expense reduced by 3.30%, and this also corresponds to a reduction in long-term debt and short-term debt on the financial statements. We will have to confirm payments of these liabilities and also ensure that the remaining debt has been correctly valued and classified, all interest, and also that all interest has been recorded. Are there any needs for any approvals? Cascade also has subsidiaries out of Canada and also sells abroad. The Canadian currency has not been very strong throughout the year. That is why you've seen a forex gain, which went up 124% versus last year. Other items to look at will include the share of associate profits, which is down 13.51%. On the balance sheet side, PP&E represents 42.43% of total assets, which seems normal considering how capital intensive the industry is. There is an increase of 0.62% versus 2015. This may be a combined effect of acquisitions and dispositions, so we'll need to validate these changes by applying the appropriate audit procedures. Account receivables went down 2.96% despite sales going up. Accounts payables went up 7.83% versus 2015. Contingent liabilities have stayed the same versus 2015. But given that Cascade operates in an industry where there may be fines for incorrect disposal of waste and hazardous materials, and also where employees may get injured in their factories, we would have expected to see maybe an increase in contingent liabilities. We will have to confirm this with management during our audits. Thank you.
The ratio analysis is used as a tool during the planning phase of an audit to assess the relationship between various financial statement accounts balances. While calculating the ratios is a rather mechanical process, the interpretation of the results will enhance the understanding of Cascades and will help the audit team to identify accounts which are at risk of misstatement. Gross profit margin remains stable at 15.5% from 2015 to 2016. There is a significant improvement observed in the rest of the profitability ratios due to the higher profit in 2016. The change from 2015 to 2016 increases the inherent risk of overstatement of profit and more specifically, overstatement of sales and/or understatement of expenses. Liquidity ratio that illustrate Cascade's liquidity situations are the current ratio and asset test, also known as quick ratio. As shown in Table 2, we have also calculated the inventory turnover ratio and the receivables turnover ratio. There is a slight decrease in both current and quick ratio due to the slight decrease in current assets, more specifically receivables. There aren't any unusual fluctuations which would increase the inherent risk. Inventory and receivables turnover are also stable within the expected ranges. Table 3 shows the debt-to-equity ratio and times interest earned ratio. Both debt-to-equity ratio and times interest earned have improved from 2015 to 2016. Here, the liabilities and interest expense accounts are at risk of understatement. Cascade uses several KPIs to measure its performance and the performance of its senior management. These KPIs provide us with an insight into the accounts the company focused on when preparing its financial statements. Consequently, these accounts are more susceptible to misstatement. The financial performance of Cascade is measured by return on assets in percentage, return on capital employed in percentage. Both return on assets and return on capital employed are non-IFRS measures. The complexity of both measures, as well as the multiple adjustments mentioned in the statements, increase the risk of misstatement of multiple accounts on the balance sheet and income statement. Those are sales, which could be overstated, selling and administrative expense understated, financing expense understated, assets understated. The working capital is another KPI, which includes accounts receivable plus inventories less trade and other payables. Since accounts receivable, inventory, and trade payables affect return on capital employed and working capital in opposite direction, we could conclude that the risk of misstatement due to measuring the performance with these KPIs is mitigated.
The evaluation of fraud risk is important since a client at high risk will require a more substantive strategy. Fraud is usually explained via the fraud triangle model, which describes the three necessary elements for fraud to occur. First, pressures or incentives to commit fraud must exist. For example, the proportion of executive management compensation that is composed of variable pay ranges from 0.57 to 1.74 times the base pay. 70% of variable pay is based on business unit performance, and the remainder is based on whole company performance. Thus, there is strong incentive for management to present strong financial results to maximize their earnings. Second, fraud cannot occur without the opportunity to commit it. Opportunities for Cascade's management or employees to commit fraud include accounts that rely on estimates and judgments such as depreciation and complex transactions such as deferred income tax provisions. These opportunities for fraudulent financial reporting are attenuated by strong and effective internal controls, which have not changed since the prior year audit, and strong corporate governance mechanisms. Furthermore, management is unaware of insider unethical activity. Finally, attitudes and rationalizations are management and employee beliefs about ethics and justification for fraudulent activities. The following company policies suggest that management takes its commitment to preventing fraud seriously. The newest version of the Code of Conduct will include anti-corruption and anti-fraud policies, including a dedicated telephone line and secure web-based service to report fraudulent activity anonymously. Given the analysis of the elements of the fraud triangle, we are of the opinion that fraud risk is low. Although the responsibility for detection and prevention of fraud rests with those charged with governance, the auditor is obliged to follow specific audit procedures related to fraud investigations. These include attending a team meeting on fraud risk, consider the risk of material misstatement due to fraud and obtain sufficient and appropriate evidence, and inquire of management if they suspect or are aware of a known fraud. While there is no guarantee that the auditor will detect a fraud if one exists, these procedures, along with professional skepticism, can minimize fraud risk. Based on our analysis, we conclude that Cascade's inherent risk is high.